Hello viewers, let's now focus in on the second part of valuation, which is the terminal value. That's our second part, terminal value. This one right here, the terminal value. So let's focus on that terminal value. And this diagram here will look the same as the last one we had, but we are focused on year 6. So our focus here is on year 6. That's where we are going to focus, where we have a forecast for unlevered free cash flow. So this is the forecast for unlevered free cash flow. It is the one that we've now put in in blue. So they are the ones that are highlighted in blue. And now we can see that unlevered free cash flow of 17,200 US dollars in that year 6 for the unlevered free cash flow here. We are going to make use of these other two values, these ones here, the terminal growth rate of 2% and the weighted average cost of capital of 13.5%. This one right here. So those two values that you can see from this box here, that small box, those two values that are there, we are going to use them. So what we are going to do in this part of valuation is we are going to make the assumption that unlevered free cash flow, this one here, the assumption that we are going to make is that this unlevered free cash flow, this one right here, the one of $17,200, is going to grow forever at the rate of, it's going to grow at the rate of 2%. That is the growth rate. So this rate of 2%, it's going to grow at this rate of 2%. The growth rate, we refer to that 2% growth rate as our terminal growth rate. And we are going to, and what we are going to do is we are going to use a growing perpetuity formula. In other words, the growing perpetuity formula. This is the growing perpetuity formula that you are seeing. Growing perpetuity formula. So that's the formula that we are going to use, whereby the present value in year 5 here, the present value for this year 5, the PV for year 5 of year 5, the present value of year 5 there is going to be equaling to the cash flows in year 6. The cash flows in year 6, this 17,200 divided by R, and our R is the discount rate of 13.5% minus the G, and our G is the terminal growth. The G is the terminal growth, R is our work, and CF6 is the cash flow in year 6. So when we divide that, we shall get the present value of year 5 as $149,565. So that's the formula that we are going to be focusing on. So I've tried to feed in the cash flows in year 6, and we've divided that by the discounting rate minus the terminal rate, and that's going to provide us with the present value in year 5. So this present value here that we've gotten, it's supposed to be in year 5. So we've divided the 17,200 by the 13.5% minus 2%, and it gave us a value of $149,565. dollars. And we can see that this very figure here in this row here, this one in blue. You can see this value here in blue here. That is the terminal value. So that's the value that we are going to have. Remember, the reason as why we are putting this, we're not putting it in year 6, is because we are discounting from year 6. Remember that our discrete values, they stopped in year 5. Meaning it's that year 5 that when we discount this cash flow of year 6, cash flow for year 6 will be brought to year 5. That's why you are seeing that cash flow, that present value, we've put it in that year 5. So you are seeing that value in the table here. We've put it there. Now, one of the critical things to understand from this formula, in other words, one of the things that we need to understand from this equation here, this equation that we have here, one of the critical things that we need to understand in that equation is that a lot of people forget that when we input the cash flow of this year 6, the 17,200 in year 6, and run it through the formula, it gives us the present value 1 year prior to that. That is very important. So in other words, the value that you are seeing as the end result of 149,565 US dollars is for the year 5, not for the year 6. That's what we need to understand. And another way to think of this is that this perpetuity growth formula here, this perpetuity growth formula always gives us 1 year of discounting. In other words, if we are discounting a value or a perpetual growth value, it only gives us a 1 year of discounting. In other words, we can't discount this cash flow in year twice, that we discount this and we put it maybe to this point. No, it is only single year of discounting. So as we discount from year 6, we have to put it back to year 5. That is 1 year of discounting. But what we need to do now is we need to get that year 5 cash flow amount. So the year 5 cash flow amount all the way back to our valuation date. And that's what we are going to do in the next step. Because you are seeing this figure here, this figure that we have here, we need to put it back to our cash flows. Remember, these are our discrete cash flows, and they were going up to year 5, meaning there are some values that have been added on that last year of year 5. So by bringing this figure back to our cash flows that we are discounting, we put it in year 5 and we add them so that we can get the total cash flows. They are the ones down here. So these total cash flows that you are seeing here, these ones here, they are the ones that we are going to use. So let's now move forward and concentrate on getting the cash flow of this 149,565 US dollars back to year 5 for, because when you put it back to year 5, that is our year of valuation, that is our valuation date. We can now bring this table here. This table right here is the table that we are going to use now. So Again, this table, we are going to focus on the present value of the terminal value. In other words, we are going to focus, our focus is going to be on this value here, the present value of the terminal value at the bottom. So since we are picking this value back, because these are going to be the total cash flows here. Since we've gotten these total cash flows, these ones here, and now we discounted these total cash flows back to our valuation date. Let's assume that our valuation date is this 2024. And now these years we are starting from maybe 2025. If you add here, then this one is 2029. Let's assume like that. And now we discounted all these cash flows that we have here, and we gotten their present value. So their present value was equating to this, and that was equaling to our enterprise value. But remember, we had already discounted these ones, the first one, these ones up. We had discounted these ones for the discrete, and they gave us 56.23 US dollars. So the issue here is that if we discount this one, the 149,565, we discount it back to the present, and now we get back to our present value, this figure here, which is 79406. So it is these two values, when you sum these ones, this one and this one, they will give you what we call the enterprise value, EV. So that's the kind of mathematics that we are trying to have in place. So that's what we are trying to get. So now that we've seen those values, we've been able to look at this terminal value at the bottom here. At the bottom, the terminal value of that figure, 79406, and that value, we are going to deploy we deployed the NPV function. So that will look similar like to the last time we did. We've gotten this value and we took it back using the NPV function, and we've gotten in this one. So what we are going to do here with the NPV function, we've put in all those values. So with the NPV, actually you come and put in all these values here. So these results here that we have here, they are the present values. So when we sum up the present values for the discrete plus the present value for the terminal, we get what we call the enterprise value. And that enterprise value will be the value of the company, which is roughly 130 US dollars, 130,000 US dollars. So in the next discussion, we are going to talk about the enterprise value and how we can go even further and get to the equity value. Because the enterprise value is for all, it is the value of the business, including all the equity providers and the debt providers. So we are going to use the enterprise value. We go back to the equity value, but you've seen how we've gotten the enterprise value is by looking at the present value of the discrete values or forecasts and the present value of the terminal value. When you sum them up, you can be able to get what we call the enterprise value. So we'll see you in the next video.